Bitcoin presents a profound challenge to the traditional banking system because it offers a fundamentally different way for people to store, transfer, and secure value. Unlike banks, which require institutional trust, centralized infrastructure, and layers of intermediaries, Bitcoin operates through decentralized consensus, cryptographic proof, and peer-to-peer settlement. This shift threatens the core functions banks have controlled for centuries: custody, payments, lending, settlements, and monetary issuance, and could gradually make them obsolete as adoption grows. The foundation of Bitcoin's challenge lies in decentralization. Banks act as middlemen in nearly all financial activity. They approve transactions, hold deposits, settle accounts, and maintain ledgers. People cannot simply move money freely. They must request permission, comply with identity requirements, and accept delays or restrictions that banks impose. Bitcoin eliminates this dependency entirely. Users can store and transfer funds without requiring approval, oversight, or access to banking infrastructure. Value is secured by private keys rather than institutional promises. Settlement occurs on a global ledger, controlled by no single entity. This changes the nature of financial participation from something granted by institutions to something individuals control directly. Traditional banks derive power from gatekeeping. Opening an account, withdrawing large sums, sending international transfers, or accessing credit often requires approval and documentation. Banks can freeze or seize funds at the direction of governments, courts, compliance officers, or risk departments. Customers cannot meaningfully resist these controls because banks act as custodians with legal authority over deposits. Operating under centralized infrastructures enforced by state regulation, Bitcoin, by contrast, gives ownership directly to users. If individuals hold their own private keys, funds cannot be confiscated, frozen, or restricted without physical access to those keys. This level of autonomy has never existed at scale in modern finance and fundamentally weakens banks' custodial role. Another reason Bitcoin threatens banks is its monetary policy. Banks operate within fiat systems where money supply expands continuously through central bank policy and fractional reserve lending. Inflation erodes purchasing power and incentivizes borrowing rather than saving. People with limited financial access often hold savings in local currency vulnerable to devaluation, making inflation a hidden tax on the poor. Bitcoin's fixed supply of 21 million coins is enforced by code and consensus rather than political decisions. Monetary issuance follows a programmatic schedule immune to manipulation. This creates digital hard money similar to gold, but more portable, divisible, and verifiable. If individuals increasingly save in Bitcoin rather than fiat, the banking model based on fiat deposits, credit creation, and monetary expansion weakens significantly. Banks also control payment infrastructure. International wires, clearinghouses, correspondent networks, card processors, and settlement systems require centralized intermediaries. Transfers often take days, incur fees, and operate only during business hours. Bitcoin transactions settle globally within minutes, regardless of borders or time zones, without requiring approval. Fees are transparent and generally predictable. Second-layer networks like Lightning enable instant micropayments at negligible cost. Bypassing debit networks, remittance services, and international transfer systems that extract billions in fees each year. Lightning adoption expands. It threatens the revenue banks generate from payment processing and foreign exchange spreads. Decentralized settlement challenges banks philosophically as well as technologically. Settlement finality, meaning irreversible transfers, fundamental to finance. Yet banks struggle to provide true finality due to dependency on clearing networks and legal processes. Bitcoin settlement is trustless and final at the protocol level. No reversal, dispute, or third-party arbitration is necessary. This removes entire industries built around fraud prevention, chargebacks, and dispute resolution, simplifying commerce and reducing costs for merchants and consumers. Regulatory frameworks, banking policies, and compliance requirements create barriers that banks use to maintain influence. Identity verification, credit approvals, minimum balance requirements, geographical restrictions, and risk assessments exclude many individuals. Billions of people worldwide cannot open bank accounts due to documentation or income challenges. Bitcoin is permissionless. Anyone with internet access can participate. This universal access offers financial inclusion similar to how mobile phones democratize communication. In developing economies, mobile Bitcoin wallets could leapfrog expensive banking infrastructure, just as mobile networks replaced landlines. History repeatedly shows that banks fail, mismanage funds, or impose withdrawal restrictions during crises. The Great Depression, the 2008 collapse, and modern inflationary events reveal systemic fragility. Deposit insurance offers conditional protection, but depends on government guarantees that can fail during extreme crises. Bitcoin ownership avoids counterparty risk entirely because users custody their own funds. If self-custody spreads, deposit reliance declines, reducing banks' lending capacity under fractional reserves. Without sufficient deposits, banks cannot create credit at current scales. This gradual capital flight could destabilize profit models built on interest and lending spreads. Public trust in banks erodes with each scandal, bailout, hidden fee, or monetary policy failure. Bitcoin offers transparency through an open ledger, predictable issuance schedule, and distributed governance. Protocol rules cannot be altered by politicians, corporations, or central banks. This neutrality is attractive in a world of rising geopolitical tensions, inflationary pressure, and distrust in institutions. Individuals living under authoritarian regimes or volatile currencies already use Bitcoin as economic escape infrastructure to bypass capital controls and protect wealth. As currencies depreciate or governments impose restrictions, decentralized alternatives become increasingly appealing. Critics argue that Bitcoin lacks scalability to replace banking systems. Yet technological improvements continue to expand capacitor Lightning Network channels. Satoshins, batching, Schnorr signatures, and other proposals enhance throughput, while maintaining decentralization. Historical parallels help clarify why this limitation may not prevent adoption. Early internet infrastructure lacked bandwidth and speed, yet development continued until large-scale adoption was feasible. Similarly, Bitcoin scalability may evolve alongside demand. The rise of decentralized finance strengthens Bitcoin's disruptive potential. Smart contracts and non-custodial financial tools enable lending, borrowing, saving, settlement, and programmable payments without requiring banks to intermediate. Automated protocols reduce counterparty risk, discrimination, and approval barriers. If individuals prefer non-custodial financial products over bank-controlled equivalents, capital flows shift away from traditional institutions. Younger generations are more comfortable using digital tools and more skeptical of institutional authority. As generational wealth transfers occur. Bitcoin adoption could accelerate as digital natives manage assets differently than previous generations. Bank revenue streams depend heavily on fees, interest spreads, custody, and currency services. Bitcoin threatens all these functions simultaneously by offering decentralized alternatives that operate globally at lower cost. Stablecoins, cytokines, and Layer 2 protocols demonstrate programmable settlement independent of banks. Even if banks adopt blockchain technology, centralized versions reproduce the same control structures Bitcoin was designed to bypass, making them less competitive. Regulations may attempt to integrate cryptocurrencies into banking frameworks, but decentralized networks exist beyond jurisdictional boundaries and cannot be shut down by legal prohibitions alone. Unlike centralized payment processors, Bitcoin nodes operate globally, resistant to censorship or control by any state or corporation. Over time, financial activity could migrate toward decentralized systems, not because banks collapse suddenly, but because individuals choose sovereignty, transparency, and faster settlement. Banks could gradually lose relevance as customers withdraw deposits, payments shift to decentralized rails, and monetary authority migrates toward code. Competitive advantage favors systems that provide security without requiring trust in centralized institutions. Bitcoin aligns incentives for global participants by securing the network through energy expenditure and cryptographic validation, rather than human discretion. The transformation Bitcoin represents is more than technologically as philosophical. Money historically required centralized authority to issue, regulate, and secure value. Bitcoin redefines money as an open, borderless protocol governed by mathematics and community consensus rather than politics. Users control value directly, eliminating dependency on institutions that have repeatedly demonstrated fragility, mismanagement, and self-interest. This shift represents a reimagining of economic agency, where individuals, not centralized banks, control financial destiny. Transition to Bitcoin-based systems would not remove banks overnight. Instead, banks could become obsolete gradually, as market incentives drive people toward decentralized alternatives with lower costs, better access, and stronger guarantees of ownership. As digital literacy spreads and infrastructure improves, the friction preventing mainstream adoption diminishes. Bitcoin could become a global settlement layer supporting diverse financial applications, built on open protocols rather than bank-controlled networks. If adoption reaches a critical threshold, feedback loops accelerate migration away from banks toward decentralized finance. Declining bank deposits reduce lending ability and profitability, leading to contraction, increased fees, and reduced competitiveness, further incentivizing migration. In this future, banking functions payments, lending, liquidity, settlement operate through decentralized networks rather than centralized institutions. Banks may survive as niche service providers or integrated layer to custodial facilitators, but the core role they play in money creation, custody, and settlement disappears. Bitcoin ultimately enables a financial system where value flows freely across borders, resistant to censorship, inflation, and institutional control. Individuals gain economic sovereignty through cryptographic security rather than institutional trust, fundamentally transforming the relationship between people, money, and power.